Remember that being prepared for opportunities is the best way to ensure your success, regardless of who wins the election. Before each election, the market often experiences significant fluctuations, causing some investors to be easily swayed by short-term trends or emotional predictions. This can lead to risky, thoughtless decisions. But if you understand the importance of thorough preparation and having a sound investment strategy, you will secure the opportunity to create sustainable growth for your portfolio, regardless of the election outcome. Investment is not just about action, but also about how you think, how you build and protect your ideas, because mindset directly affects investment outcomes. As Earl Nightingale said, you become what you think about. This is also true in investing. When you think positively and systematically about what you desire, you not only develop your investment portfolio, but also build a correct and sustainable investment mindset. Our goal is not to predict the election outcome, but to build a strong investment portfolio that is suitable for all conditions. Short-term market fluctuations are just a part of the game, but with a long-term strategy focused on specific financial goals, you will maintain your consistency and stick to your strategy even in the most unstable times. In investing, mindset acts as a compass, guiding all your decisions and actions. To build a successful investment portfolio, first, it is essential to clearly define the goals. Brian Tracy introduced the law of mental equivalency, emphasizing the importance of visualizing and specifically defining what you want to achieve. In investing, this is not just a principle, but an important strategy. Visualizing the financial success you are aiming for will help you shape your mindset in a specific and sharp manner. Long-term goals need to be built from a systematic mindset, unaffected by short-term market changes. This visualization does not just stop at the desire to achieve something, but rather creates a clear picture of what you want your assets and portfolio to achieve within a certain period. During the election period, the market always experiences certain fluctuations. To avoid emotional investing, having a clear visualization of your investment portfolio will help you stay on track. The law of mental equivalence encourages investors to clearly define the outcomes they want to achieve, which will help you maintain faith in your goals even when facing unpredictable changes. This is especially important when facing short-term fluctuations during the election period. When you clearly establish the financial picture you want to achieve, you will create a solid standard for all your investment decisions. This is how you maintain focus and not be swayed by temporary fluctuations. Another rule that has a significant impact on the investment process is the law of correspondence, which emphasizes that your investment portfolio is a reflection of your mindset and preparation. What you see on the outside is the result of what you have prepared for mentally and strategically. Investment is not simply a financial activity. It is also a way for you to demonstrate consistency in your thoughts and actions. If you approach investing with a positive mindset and a solid strategy, your portfolio will reflect that stability and sustainability. On the contrary, if you lack preparation and investment with a hesitant or emotional mindset, your portfolio will tend to fluctuate more and be easily influenced by external factors. A successful investment portfolio is not a random coincidence, but the result of thorough preparation, a sound strategy, and unwavering determination. If you maintain consistency between your goals and actions, you will easily avoid common mistakes, such as investing based on uncertain predictions or following the crowd mentality. That's why during the election period, a phase prone to significant fluctuations, you need to ensure that every investment decision is based on mature thinking and a solid foundation. The law of correspondence reminds us that a portfolio is only strong when it truly reflects a solid mindset, thorough preparation, and an unwavering strategy. In addition, an indispensable factor is unwavering belief in one's own strategy, which the law of belief emphasizes very clearly. In a volatile market, having faith in your financial decisions and goals will help you remain calm and rational, even when the market experiences significant turmoil. An investment portfolio that reflects your belief in long-term success will easily withstand short-term fluctuations. When you believe that you will achieve the financial goals you have set, every investment decision becomes more certain and wise, rather than wavering in response to immediate factors. That's why you need to build trust in yourself and in your investment plan before entering a volatile period like the election season. Confidence in investing not only helps you maintain your stance, but also serves as a motivation for you to continue acting according to the strategy you have set. That belief is not easy to attain, but once you have developed a positive mindset, a sustainable strategy, and self-confidence, your investment portfolio will reflect the stability you desire. The fact is, A strong belief in your goals and investment plan will help you overcome all market fluctuations and navigate difficult periods more calmly. If you are mentally prepared, the difficulties and challenges will only serve as stepping stones to help you go further. When you maintain faith, your portfolio will no longer just be a collection of assets, but also a manifestation of your spirit and control. Belief is the factor that transforms you from a directionless investor into a visionary. Instead of being passive in the face of short-term fluctuations, you will be ready to look further ahead, focusing on long-term values and not being distracted by temporary oscillations. Regardless of the election results, trust in your plan will help you build a stable investment portfolio aimed at sustainable development. This very belief will be the foundation for you to stand firm, overcome short-term obstacles, and achieve the long-term financial success you desire. The election period is a phase when the financial market is sensitive to the policies of the candidates, as each person has their own viewpoints and strategies. For investors, it is important to analyze the impact of potential policies on their portfolios, thereby guiding them correctly. When it comes to Trump's investment policies, we see that the goal of economic growth is the top priority. His policies aim to reduce corporate taxes, loosen regulations, and focus on the traditional energy sector. These changes, if implemented, are likely to drive strong growth for small businesses, bringing a revival to the small-cap stock group, thereby creating investment opportunities in the stock market. Tax cuts will help businesses retain more profits, have the ability to scale up, and create more jobs. This will boost demand for products and services, providing the market with the momentum to grow. With the trend of supporting traditional energy industries, Trump's policies could also boost this sector. The easing of regulations on traditional energy makes it easier for companies in the industry to expand extraction and invest in new infrastructure, benefiting oil, gas, and coal companies. With support from the government, investors in the traditional energy sector will have more long-term development opportunities. Meanwhile, if Harris comes to power, it is highly likely that environmental protection and clean energy policies will be given more emphasis. Harris is committed to maintaining regulations on renewable energy, reducing dependence on traditional energy, and prioritizing the development of new energy sources. In addition, the increase in corporate taxes is also part of her policy, aimed at boosting the state budget and investing in social welfare programs. This means that renewable energy companies and environmentally friendly industries will have strong growth opportunities thanks to government support and incentives. Businesses operating in the fields of solar energy, wind energy, and other green technologies will receive more investment, bringing strong development potential. However, the increase in taxes may reduce the profits of some businesses, especially traditional ones. This requires investors to weigh the option of investing in green industries and limiting investments in sectors that will be heavily affected by tax increases. The differences in policies of each candidate will have certain impacts on various investment sectors. Some investors may choose to allocate capital flexibly, preparing to deal with any outcome of the election. To achieve this, balancing the portfolio has become more necessary than ever. Investors can predict the impact of both candidates' policies and build a portfolio that harmonizes and takes advantage of both directions. For example, if you see potential in Harris's policies on clean energy, you might consider investing in funds or stocks of companies in this sector. At the same time, if you also see potential in Trump's tax reduction policy, allocate some capital to invest in small companies or traditional industries. This flexibility helps your investment portfolio not to be entirely dependent on the election results and to adapt to any policies implemented after the election. Another important factor is to protect your portfolio from inflation risks. Regardless of who wins the election, interest rates are likely to remain low to stimulate economic growth, and this could lead to increased inflation. Inflation will reduce the purchasing power of money, and to counter this, investing in inflation-resistant assets is a necessary strategy. Real estate and REITs are two popular choices because the value of these assets often increases when inflation rises. In addition, you can also consider investing in commodities such as gold or other physical assets. When these assets increase in value along with inflation, your investment portfolio will be protected from depreciation and will maintain stable value. Choosing inflation-resistant assets in your portfolio not only helps you protect the value of your assets, but also creates sustainability when the market fluctuates. Regardless of the election results, it is important that your portfolio is prepared for potential economic factors. Both candidates have reasons to maintain low interest rates, so protecting the portfolio from inflation risk becomes indispensable. When you build a diversified investment portfolio, including assets with inflation protection, you are creating balance and stability. This is a way to ensure that the value of your investment portfolio will not be significantly affected by market fluctuations. Choosing this strategy will help you overcome short-term impacts and create a more solid investment foundation for the future. In general, thoroughly evaluating the impact of policies from both candidates will help you orient a reasonable and balanced investment portfolio. You don't need to predict exactly who will win, but just have a diverse and flexible plan to embrace potential changes. When your investment portfolio has been built with protective factors and clear strategies, you will feel more confident and less affected by short-term political fluctuations. This not only helps protect asset values, but also facilitates stable, long-term growth, regardless of policy changes resulting from elections. Building a long-term investment strategy requires a high level of focus on sectors with sustainable growth potential and the ability to maintain stability through various market phases. The Law of Concentration, or Law of Concentration by Brian Tracy, emphasizes that the things you focus on and put your heart into will grow over time. In the context of investment, this law encourages us to focus on specific investment areas rather than spreading assets across too many unnecessary options. In reality, a concentrated investment portfolio with long-term growth potential often makes it easier for you to control and evaluate performance compared to a diversified portfolio. When you choose to invest in areas you believe have long-term potential, you will no longer feel the need to chase short-term fluctuations. This is how you can build a solid foundation for an investment strategy that won't be shaken by sudden changes. In addition to focusing on specific sectors, diversifying the investment portfolio is also an indispensable part of the long-term strategy. Diversification helps reduce risk and enhance the sustainability of the investment portfolio. When you allocate assets to different sectors, you will create balance in the portfolio, helping the assets not to be significantly affected when one sector encounters difficulties. A diversified investment portfolio is one where each part complements and protects the others, helping the investor maintain asset value even when the market experiences significant fluctuations. For example, if the stock market experiences significant fluctuations, but you invest in bonds or other fixed assets, the stability from these assets will help balance the risk in the overall portfolio. That's how diversification not only minimizes risk, but also brings flexibility, helping your portfolio adapt well to various market conditions. One of the great opportunities in the market, especially during election periods, is to take advantage of short-term fluctuations to find good buying moments. The market often tends to fluctuate significantly during this period due to the uncertainty from policies that may change as candidates campaign. The concentration law in investment also emphasizes that if you have identified long-term potential sectors, you can take advantage of short-term fluctuations to invest in valuable assets at reasonable prices. When other investors are easily swayed by political news and decide to withdraw from the market, that's when you can take advantage of the opportunities the market presents. Buying valuable assets when the market is volatile is a smart strategy to build a portfolio at a lower cost, thereby optimizing profits when the market recovers. By taking advantage of short-term fluctuations during the election period, you can not only seize good opportunities, but also build a solid foundation for long-term goals. Developing a long-term strategy requires you to always maintain your spirit and not let external factors distract you. When you focus on long-term investment goals and stick to your chosen sectors, you will not be affected by short-term market fluctuations. The fluctuations that may occur before and after the election are just temporary changes. But if you have a solid investment strategy, these short-term factors will not alter the direction you have chosen. Long-term investment is not about trying to predict every fluctuation, but about building a solid foundation capable of sustainable growth through all periods. This is why successful investors often focus on long-term strategies, as they know that sustainable success does not come from impulsive decisions, but from steadfast adherence to a predetermined strategy. A long-term strategy not only helps you build a stable investment portfolio, but also brings peace of mind, as you don't have to worry about short-term political changes. When you have a well-prepared and considered strategy, fluctuations only become opportunities to adjust and add to your portfolio. You will always maintain control and proactivity with your portfolio instead of reacting to market fluctuations. This also helps you maintain consistency in your investments, stay focused on your goals, and not be distracted by unnecessary factors. When you focus on long-term strategies and know how to smartly seize short-term opportunities, you will gradually build a strong and sustainable investment portfolio, regardless of the election results. A strong and sustainable investment portfolio is not just based on individual decisions, but is the result of a planned, goal-oriented investment process and the ability to adapt to various market conditions. When you have a clear strategy, you won't easily be swayed by short-term news or fluctuations during the election period. Stability in investment does not only come from acquiring valuable assets, but also from the ability to control and provide clear direction. This helps you not only face the immediate changes, but also leverage them to your advantage in your long-term plans. A long-term strategy with focus and diversification is the foundation to help you achieve your financial goals sustainably. Investment does not stop at strategy and planning. It also depends on decisive action and a positive mindset. A perfect strategy would be meaningless without the determination to act. The law of motivation emphasizes that action is the key to success. When you have strong motivation and act towards financial goals, every decision will become clearer, and you will see yourself progressing further each day. Motivation helps maintain perseverance, allowing you to continuously pursue your goals even when the market fluctuates. Your willingness to prioritize action will give you the ability to turn ideas into reality, helping each goal you set to gradually come to fruition. Motivation does not come from the outside, but rather from within. It stems from the reason why you invest and what you hope to achieve from your portfolio. Decisive action needs to be combined with an optimistic mindset and positive expectations, which is precisely what the law of optimism and the law of expectation, law of optimism and law of expectation emphasize. Positive thinking not only helps you maintain your mindset, but also opens the door to new investment opportunities. When you expect success, you will more easily face challenges with a readiness mindset, and you might even see potential within those very challenges. An optimistic mindset helps you view the market wisely, without rushing or being pessimistic in the face of temporary fluctuations. Positive expectations do not mean that you deny the risks, but rather that you maintain faith in the long-term strategy and the ability to overcome difficulties. Positive thinking also helps you turn temporary failures into valuable lessons instead of seeing them as an endpoint. Any investor will face difficult times, but it is the optimistic mindset and positive expectations that will help you stand firm. When facing failures, instead of focusing on the negative aspects, you can learn, gain experience to adjust your strategy, and aim for wiser decisions in the future. That's why an optimistic mindset is one of the factors that helps maintain a sustainable investment journey, allowing you to always see the value in each step and never back down from challenges. Effective action is also accompanied by the formation of good investment habits, which is mentioned in the law of behavior and habit. Building the habit of regularly monitoring and controlling your investment portfolio is an important part of the long-term investment journey. When you habitually monitor and evaluate your portfolio regularly, you will not be caught off guard by unexpected market fluctuations. This habit helps you quickly identify potential risks or new opportunities and thereby promptly adjust your strategy. Portfolio management is not just about checking the numbers, but also about examining whether the current portfolio still aligns with the set objectives. This helps you maintain consistency and avoid being swayed when the market fluctuates. Positive investment habits also include continuously learning and updating new knowledge. The market is always changing, and investment tools are constantly evolving. When you cultivate the habit of learning, you equip yourself with the necessary tools to handle various situations, thereby helping you become more confident when facing any circumstance. Continuously learning and enhancing investment knowledge helps you become a flexible investor, knowing how to adapt and leverage new tools to strengthen your investment portfolio. Building this habit also helps you easily maintain a positive mindset and confidence in your investment goals, even when the market experiences significant fluctuations. Ultimately, consistent action is the key to sustainable success. When you turn your investment principles and plans into daily action habits, you will create persistence and consistency in the investment process. Consistency not only helps you pursue investment goals clearly, but also helps you maintain confidence even when facing challenges. Consistent action is not only about executing what has been set, but also a way for you to maintain motivation, keep your spirits up, and create a strong investment portfolio through each phase. When actions become habits, you will no longer feel threatened by the market, but will feel confident because each step has been prepared and calculated. With decisive actions, an optimistic mindset, and control habits, your investment portfolio will become increasingly robust and develop steadily. Every success is the result of perseverance and consistency, and when you know how to combine action with positive thinking, you will gradually move closer to the financial goals you desire. Good habits will help you not only manage your investment portfolio, but also build confidence and the ability to adapt flexibly to any changes. No matter how the market fluctuates, as long as you maintain a positive mindset, take consistent actions, and cultivate good habits, you will build a solid investment foundation and gradually move towards success. The investment journey is a long-term journey that requires perseverance, trust, and consistency in every decision. The important thing is not to chase the short-term fluctuations of the market, but to focus on long-term goals, building a portfolio that can withstand any challenges. No matter how much the market fluctuates before each election, successful investors always know that success does not come from trying to predict short-term fluctuations. Instead, they build a solid foundation based on established investment principles and clear long-term goals. Remember that our goal is not to achieve short-term profits, but to build sustainable growth. When you focus on long-term development, all short-term fluctuations become just a small part of the bigger picture. Perseverance is an indispensable factor in this journey. When you set a goal, it is important to be patient and consistently implement the plans. Investment is a long-term journey that requires dedication, and only perseverance can help you stay the course through all market phases. There may be times when the market doesn't move in the direction you want, but remember that every success is the result of perseverance and focus. When you persist and trust in your strategy, you will build a stable portfolio ready to handle any changes. Don't let short-term fluctuations make you lose your direction, because perseverance is the foundation for building a solid financial future. Always maintain a positive mindset and focus on long-term values. Long-term investment is not only a way to achieve financial success, but also a path to building stability and peace of mind in life. When you have a long-term plan and know how to maintain self-confidence, you will no longer feel anxious about each short-term fluctuation. You will realize that what you build is not a temporary profit, but a sustainable foundation, a stable future for yourself and your family. Invest not only to achieve profits, but also to build a life of peace, unaffected by the immediate changes of the market. This is the approach that all successful investors aim for, building stability and consistency with their long-term strategy. We do not wait for the election results to decide the future, but we take charge today to build a solid financial future. No matter who wins the election, as long as you persevere, act with purpose, and maintain a positive mindset, you will achieve the success you desire. It is the thorough preparation, patience, and long-term thinking that will be the foundation to help you stand firm on the journey of investment and building a sustainable future. Every decision you make today will be the foundational bricks to create a stable and fulfilling life for yourself and your family. Don't let short-term factors distract you or make you lose motivation, because you are on the path to building a financial future that you deserve to achieve.